Welcome to Matters Financial and Geopolitical from a Frontier. Thank you as always for stopping by. I'm grateful. You can of course catch us at 8 to 9 p.m. on Metropole TV, which is the first 24-hour business news channel here in Kenya and East Africa, and I must say enjoying that as well. Trump, standing next to Abiy, called Chairman Kim a very smart man, downplayed Pyongyang's missile tests, and talked up great waterfront property in North Korea ripe for development. Shinzo Abe isn't known for his art of the deal. That's Donald Trump's shtick. But in Tokyo, the Japanese Prime Minister flipped the script on his US counterpart. Trump arrived in Japan on Saturday plagued by a world of troubles. Impeachment talk intensified at the same moment his much-hyped China trade deal was collapsing. A deal was not to be. Abe distracted Trump from the bilateral trade pact, the big economic win he covered so badly, with the art of distraction. The day at the sumo dojo was great fun. Trump and Abe yucking it up for the cameras was diplomatic gold. Well-done steak dinners, the golf outing, the first audience with Japan's new emperor, and the palace banquet. The exchange exposed the dilemma facing Japanese officials. How do you negotiate with someone who seems to understand neither trade nor basic economics? Japanese automakers directly employ upwards of 1.5 million Americans. Add in related industries in Alabama, Louisiana, Ohio, and Tennessee, and the number of jobs approaches 3 million. My piece over the weekend was about the China-US trade war, and I said it's turned ballistic. I said for quite a while the consensus view has been that the US and China would, after all the theatrics, reach some kind of deal. President Trump is highly tuned to the markets, as in fact something of a 21st century artiste. His positive trade war tweets are timed around the US market hours and designed to soothe, massage and finesse US asset prices. Like Trump predicts fast trade deal with China, and he turns more negative in Chinese trading hours. And I was basically saying that I think the direction of travel is very clear, and that essentially, I see this as getting more intense rather than less intense, and I don't see how either party can step down and compromise at this point. There's an editorial in the China Daily: the US wants to rob China of not only its money, but also its future. The Chinese people are so confused. What on earth does the US want with China? Does it want fair trade, or does the US refuse to accept China's development and seek to break the Chinese economy as its ultimate goal? The IMF have put out some good research on US-China trade tensions. They're saying the impact of previously imposed tariffs by the US and subsequent retaliation by China is already evident in trade data. Both the countries directly involved and their trading partners have been affected by rising tariffs. This is the IMF saying importers stocked up ahead of the tariffs, accounting for the sharper decline in imports thereafter. Came up with research by Cavallo, Gopinath, Nyman and Tang using price data from the Bureau of Labor Statistics on imports from China, finds that tariff revenue collected has been borne almost entirely by US importers. I'm not sure about that. There was almost no change in the ex-tariff border prices of imports from China, and a sharp jump in the post-tariff import prices matching the magnitude of the tariff. Talking about Mexico being a big winner, and possibly Japan, Korea and Canada. I, however, disagree with them, because I think 80% will have to be absorbed by the Chinese producer, 20% by the US consumer, by my calculation. In July last year, I said the Chinese government has been quite surgical in its response and is targeting the farm economy in particular. And the IMF agrees with that, saying this was most clearly observed in the case of soybeans, where US exports to China fell dramatically in 2018 after China imposed tariffs. The US was China's dominant soybean supplier, along with Brazil in 2017. With the tariffs, the price of US soybeans fell, while that of Brazilian soybeans increased, as US exports to China dropped to near zero, and Brazilian exports to China trended higher. Global Times is saying that China's economic expansion will slow to 6.1% in 2019 and 2020. Most countries would accept 6.1% with both hands, taking into account the latest US tariff hike to 25% on $200 billion of Chinese exports. Let's move on to the currency markets. Euro dollar 111.92, dollar index 97.75, Japanese yen strengthening again 109.28, Swiss franc 100.42, the pound 126.68, the Australian dollar 0.6920, India rupee holding below 70, 69.65. South Korean won has been a very weak feature in 2019, 11.8838. The rial resolutely over 4.4043. Egyptian pound, the outlier in the currency universe, at 16.828, and the South African rand 14.5. And I think the rand's at the bleeding edge of this China emerging market, frontier market contagion loop. This is the dollar index, still looking for that move up to 100, currently at 97.758. Euro dollar, this is from Raf Kadian, last at 111.91. We've been doing a bit of work over the last few hours around these levels. Chinese bank cocoa debt falling again after Baoshang's seizure. Baoshang was reporting an NPL rate of 1.7%, reportedly. Even Tesla bondholders are getting nervous and have increasing doubts that Tesla will survive. The price of the 2025 bond hit an all-time low, around 81 cents in the dollar. Dollar yields are now at 9.2%. Gold, 1284.46. Finding some buying support around these levels. Crude oil, after that steep drop, this is a 5-day chart, we're last at $59.05. We need to get back to 60 for the bulls. A very big story in commodities. China piglet average price has increased 111% since February. This is all about the African swine fever. Imports bring down wholesale prices, but slaughtered pig need to be replaced at some point. There aren't enough pigs in the rest of the world to replace China's loss of stock. In my article over the weekend, I was writing about how there is a China emerging and frontier market loop phenomenon which has been super positive for more than 2 decades, and I said, and is now in a major trend change and has turned negative. And in an interview on Bloomberg, Brenda McKenna, a strategist at Wells Fargo in New York, says that investors should bet against any currencies with a high exposure to Chinese risk. In particular, he's betting against the Korean won, the Philippine peso, and the Taiwanese dollar. Outside of Asia, he says the usual suspects that are susceptible to trade risk will be hard hit, and people should stay away from the Brazilian real, Mexico's peso, the Chilean peso, and the South African rand. Largely what I've been saying. What are frontier markets and why invest in them? A great article in Business Week. If emerging markets are the wild child of the investment family, offering potentially higher rewards in return for greater risk, then what about their smaller sibling frontier markets? Countries such as Sri Lanka, Kazakhstan, Nigeria, in the investing hierarchy, they are the bottom rung of 3. At the top are developed markets, in the middle are emerging markets, and then you get frontier markets. There are around 30 frontier markets, mostly in the Middle East, South Asia, Africa, and Eastern Europe. And what they look for is subjective criteria, including at least some openness to foreign ownership, and at least partial ease of capital flows. Everything's on a smaller scale. Frontier markets have a combined market value of $715 billion. Emerging market stocks are worth $20 trillion. Trading volumes are relatively minuscule, as are the number of listed companies. While Vietnam is more than 1,500, Burkina Faso counts just 3, and Benin 1. One of the main investor attractions is getting into a market before the crowds arrive. Some markets have rewarded long-term investors handsomely. Vietnam's benchmark rose by an annual average 9.8% in the decade through 2018, including a 48% jump in 2017.